The markets have actually climbed up to almost the highest point of the day. Start of the new financial year has been pretty strong. The year gone by was also a very good one, 18-19% on the index, 25-30% on the broader market indices is what we actually managed to gain, and this is after adjusting for the conflict triggered correction which we saw. So Indian markets have actually turned out to be one of the best performing ones for the financial year gone by, and now too above the 17,500 the benchmarks are gaining traction. But what are the factors at play, and how are professionals, money managers are actually approaching their framework? Santosh Singh, fund manager and head of research at Motilal Oswal AMC, is joining us now with more on that. Santosh, good afternoon. Thank you so much for your time. Let's start understanding your view on the space you understand so well, perhaps the best among all the sectors that you look at now, and which is financials. So there is so much of promise built into large cap financial private sector banks, but unfortunately the returns have been on the lower side, perhaps got to do with high ownership and FIIs are big sellers. Do you think this financial year, February credit growth data again came in at above 8%, things could actually change on the returns front also, because fundamentals things have changed, but returns did not really come by. Do you think that can change now?
Yes, actually last year, if you look at financials, was the year of were the area of contradiction actually, because this was the area which was seeing highest EPS upgrades, and this was the sector which actually didn't do much, and simply it had to do with the incremental flows where the FIs were almost selling on a daily basis, and this became a collateral damage to that. Because even during the Ukraine conflict, all the commodity market problems, and these are not commodity commodity consumers. So they should not have fallen the way they fell. So my view is, even in the next year, if I'm looking at my numbers, right, the numbers are going to be the best in this particular space, and clearly the valuations have become quite cheap for a lot of quality companies. So I think. If we are not going to see that sort of selling from the FIIs, this could be one of the best performing sectors in the next year.
So earnings are clearly going to follow through, and if absence of FII selling, this could actually turn out to be. In fact, last couple of days, FII selling has gone down. In fact, many days there have been buyers like yesterday. What about insurance? Insurance, I mean, that space has also underperformed. A lot of selling has happened. Today we were talking to Star Insurance, Star Health. They were saying from now on they are almost want to be in every district of the country. What are your thoughts on the insurance space?
So I would say actually one of the wins, other than the banking, actually insurance is better placed even than banking, simply because they had a very bad year last year because of COVID. Right? But whatever said and done, COVID was one-off. But and I'm hoping that this may not return the way the second wave happened, because the maximum damage to this sector was done in the second wave. Now, if we don't see anything like the second wave, they are very, very well placed, because people now want to buy insurance, so that the growth is not that much bigger a problem for that space. Pricing has formed up a little bit, although even the reinsurance pricing has formed up, but the pricing overall has also formed up in the retail space. So clearly that should help the profitability element part of it. So and the valuations are, I would say, this is the sector where the valuations are now almost dirt cheap for a lot of stocks, right? The fundamentals don't demand the sort of valuations they are trading at, and so what you can talk about is this is a sector which is a lot of the stocks are 1 peg or 1.2 peg with more than 20% sort of growth rates, and that's where I find means this to be very, very well placed, and maybe even better placed than even the banking sector.
What are your thoughts on looking at the way real estate space has done so well? I mean, I was just looking at Bombay registrations, one of the best in decades. Cement also followed through despite of margin pressure and high cost of transportation. Cement stocks have been resilient. But the other, and home improvement has done very well. But housing finance companies did not do very well. This is also one element of real estate revival. Why do you think housing finance did not do well? And is there a case to look at good opportunities in housing finance now?
So clearly means housing finance was again another collateral damage because this is again a part of the financials only, and another collateral damage of the overall selling, because if the housing is going to do well, housing finance has to do well. And then see, one of the factors which might have played out was that see, the COVID impact. Always the financials have slightly the positive impact or the negative impact follows through after some time. So that the hangover of COVID remained till say Q2 of last year. And from Q3, actually, numbers started flowing through, even in the housing finance. So I think from Q3, they have started actually outperforming. Some of the housing financials have started outperforming from Q3. I think for they are very well placed from now on, because see, they might see more recovery. Actually, this is a sector where you get claims first and then you get a large amount of recovery, because most of the loans are unless and until you are stuck with frauds, most of the loans are actually very well covered. So I think that there is a good case. So that's why I'm saying the entire financials is the one which has fallen despite the fundamentals improving, and that's where the a lot of opportunity we are seeing in this space.
Santosh, we are also having this chat when auto sales numbers are coming out, trickling in. We are also having this chat when today is Gudi Padwa in the south, Yugadi, Chaitra Navratra is also beginning from tomorrow. Essentially, one is getting a sense from the traders across the country that they are prepping for a big festival season and a wedding season also, where a lot of auto buying is happening. Is there merit in looking at two-wheeler stocks or even passenger vehicle stocks, or is there merit to look at commercial vehicles with capex cycle taking off? Do you find merit in that argument?
So I find definitive merit in PV, because passenger vehicles, I think see, one thing is growth. We can see growth coming in across sectors, because we two-wheelers, four-wheelers, we can see growth coming in across see, and PV is where the EV is sort of the other part of the equation is this EV, because that's one thing where we don't know the winners in two-wheeler space, because that's where a lot of competition is happening on the EV side. And ultimately, after maybe 7-8 years, we will be talking about a large portion of two-wheelers getting into the EV segment. And that's sort of a confusion in an investor's mind, that means how much do you want to take exposure in a segment where all the growth might happen, but at the same point in time, you don't know who will win, because this was a three-player market, and it might, or three or four-player market, and it might turn out to be a multi-player market, multi-pronged sort of a competitive market. So two-wheeler is where I would not be that bullish on, but PV definitely, because they have seen multiple bad years, and now things are falling into place. It's just that 1 or 2 quarters we might see a margin pressure because of the commodity prices hike which has happened. But I'm hoping that this is transitory and they are able to pass on most of it, and then even the commodity prices might cool off. But that is 1 or 2 quarters of margin pressure. But other than that, PV is a space where I would like to be very placed.
Right. Santosh, what else are you reading and researching these days? We are about to see the start of the earnings season as well. Did you manage to analyze something new, something interesting last couple of weeks?
So actually, the interesting part is only coming from the fact that we means after multiple quarters or some quarters of earning upgrade, we might see maybe downgrades coming in from next quarter. That's 1 or 2 quarter of downgrade we might see because of the commodity price pressure. So that's the only thing I think which we are trying to sort of understand, that is this going to be a transitory 1 quarter, or are we going to see multiple quarters, or is the story getting broken? The current view is that okay, this is going to be transitory because it's more because of the one-off event which has happened. But yeah, so that's the key part we are trying to sort of understand.
Santosh, the universe of stocks which you track in your fund for the purpose of management of the fund and otherwise too for academic purposes, that universe which may, I'm assuming, form large cap, mid cap, small cap, all of them together, how is the earning trajectory looking after reworking the numbers on margin pressure? For the next 2-3 years,
So
does the
see
blended earnings look still 15-18%, closer to 20%, or no, they will require to be worked lower?
means for the next year, the 15-18% might require a little bit of tempering, because 1 or 2 quarters we might see that margin pressure. But the expectation is simple, that this event may be one-off, and we might not see the oil prices or the other commodity prices at such an elevated level for a very long period of time. Because in the short duration, you can't pass everything. Right? So that's where the margin pressure in the next year might mean that we might have to temper a little bit our earning upgrades. But from if things, if it is really sort of a passing phase and we don't see an escalation of what is happening, then next 2 years, our thinking is that 15-16% earning growth should happen. And that's what we are working with.
You built in the defensive part of the market into your portfolio strategies when you recommend to key fund managers uh, in your team. Have you gone overweight on, or are you keeping a very nice chunk in pharma and IT as well, or regular weightages there? Because these are seen as relatively resilient from turmoil, global macro type of turmoil.
Yeah, so see, uh, IT definitely has been one where we have been all bullish on, and I think we remain bullish, but the valuations are telling me that now the time to sort of remain highly overweight in that sector may not be right. You might want to get sort of equal weight or somewhere around that. On IT, pharma is one where the valuations are actually quite good, and that's where I think in some of the pharma companies you might want to sort of go overweight it, and so that's one means we are looking at that IT and pharma both are defensive, but we are looking more from a pharma perspective, going overweight. And personally, I think pharma is to me more preferable than IT as of today.
Last word, Santosh, before this correction started, actually, in my eyes, it actually started in October, November, right?
Yeah.
The conflict actually just accentuated the already ongoing correction.
Yeah.
By that time, October, November period, the small cap and mid cap universe on valuation front had come at par with the large cap universe, in some
Yeah.
cases even premium. That premium got eroded in the last 8-9 months, and now discount has come. And of course, because of the conflict correction. Do you think mid-cap, small-cap universe is now offering value once again for stock picking, or do you think they should require another 10-15% before they become in good value zone?
I think the value is there and see, small and mid cap per se there is an index, but I think it's more so of a bottom of stock picking. So small and mid cap, there is value in a lot more companies than what we could see in October, November. So that has changed from October, November. We see a lot more value in a lot of stocks. So that's definitely there. Uh, I think in the near term, I would prefer large cap more than small and mid cap because simply because even the large cap valuations have eroded, and I think when the first phase, which is going to be sort of when we see a big or when we see some upswing, I think it will be more large cap driven for now, and then followed by a mid and small cap rally. So that's the view. But again, I'm saying that mid and small cap is a lot more bottom up. So there we can't take views on the space. We need to be more stock specific.
All right, Santosh, thanks very much for your time. Always enjoy our conversations. That was
Thanks,
Santosh Singh of Motilal AMC. But before we go, he was talking about insurance, why he likes it. We spoke to Star Health. Before we take a break, let's get a slice of that conversation as well.
We saw interesting trends wherein younger age group individuals and families were now buying health insurance, and it's a wonderful thing that the younger generation is buying health insurance at a time when they are young and healthy. We are also seeing the trends of good demand coming for purchase of health insurance from the semi-urban and the rural markets. So earlier health insurance was typically focused on urban areas and tier 1 metro cities. But now we are seeing in the smaller towns, in the semi-urban markets also, there's a substantial growth for health insurance. And these are very interesting signs for us. And we are looking at, developing distribution models to capture these opportunities. We have launched a wonderful product of recently, which is unique, first of its kind, focused towards women's health in the last 15 days. And we saw tremendous, uptake of that product in the last 3 weeks. So the company is constantly innovating products, innovating distribution models, so that we are able to capture this opportunity of health insurance which is available.